After years of near record low rates, it's looking like the party may be over in the mortgage market. Rates are moving back up, and the average 30-year fixed mortgage rate has now broken the 5% barrier. That's a far cry from rates under 3%, which was the average rate as recently as October. So how important is that 5% number when it comes to the housing market? Turns out it's pretty important. I'm gonna tell you why, just how much impact it could have, and why economists don't expect it to crash the market. Let's get into it. Why is 5% an important number? It doesn't seem like much, but when you're talking about buying a house, a couple of percentage points can mean a difference of hundreds of thousands of dollars. In just the first few months this year, the National Association of Realtors found that higher mortgage rates increased the monthly cost for a median US home by $300. That means average home buyers today will be paying $3,600 more a year than folks who bought in January. At 5%, US homebuyers are paying an additional $130,000 on a 30-year mortgage for a median-priced home over the life of the loan. Higher rates also change who is able to buy. A year ago, a potential buyer with an income of just over $61,000 would be able to qualify for a mortgage on a median-priced home. With mortgage rates at 5%, that rises to $84,400. Higher rates are already having an impact on the housing market. There has been a significant decline in the number of lower-priced homes sold. For existing homes priced between $100,000 and $250,000, sales have fallen by 26% from a year ago. Existing home sales fell 7% in February from the previous month, the largest decline in a year. In fact, existing home sales have declined every single month since August compared to their levels the year before. But falling sales aren't bringing down prices. They're still rising at a double-digit pace. That's largely because there's so little supply on the market, and because more home sales at higher price points raises the median sales price. Economists say that 5% number will stick out to consumers and could make some rethink testing the market. Mike Fratantoni, chief economist of the Mortgage Bankers Association, tells me with rates at 5%, MBA is likely going to pull back expectations for home sales this year. The National Association of Realtors is also reevaluating their forecast for 2022. Their director of forecasting, Nadia Evangelou, tells me that if rates average 5% for the year, 16 million potential home buyers will be priced out of the market. That includes 2.3 million first-time buyers, according to NAR's projections. But Fratantoni, Evangelou, and other economists still are not expecting the housing market to go belly up this year, even with 5% mortgage rates. That's largely because even though buying a home is getting less affordable, so is renting. The average rent in the US rose by 17% in February, to a record high, according to Realtor.com. We millennials are also reaching what economists call peak home buying age, and now represent about 43% of the buyers. We're a large generation, and Fratantoni expects that to be positive for the housing market for the next couple years, regardless of what happens with the economic and rate environment. And finally, there just isn't enough housing. Vacancy rates are at all-time lows across the country, so more people are having to make the choice between sticking it out with skyrocketing rent or stepping out and coughing up more to buy a home. Evangelou also expects inflation to cool down this year as the Federal Reserve raises interest rates, and she's predicting demand slows down. That should rein in the rapid increase in housing prices and help affordability. There were already expectations for the housing market to cool in 2022. Mortgage rates at 5% will add a little bit of ice to that cool down, but seem unlikely to end the party. You know, Slim Thug taught us a valuable lesson about the housing market in 2009. He said, "Mortgage paid off, got a house that I own. Traded in the Bentley, call it cash for chrome." I'll see you next time.